Welcome back to the Daily Crypto Deep Dive. Today is about the single most important thing you can understand if you want to survive in this game long enough to win. Why markets have bull markets, why they have bear markets, why they follow patterns, and what actually flips the switch between the two. Because if you understand that, you stop being surprised by the moves, you stop getting emotionally bullied by the chart, and you stop making the classic mistakes that wipe out most people, buying late in euphoria and selling late in fear. And we're going to do this properly today. We're going to cover both crypto and traditional markets, because they're connected now whether people like it or not. We're going to break down the drivers: liquidity, rates, narratives, leverage, supply and demand. We're going to use real examples from crypto cycles: 2013, 2017, 2021, 2022. And we'll bring in expert thinking from people like Howard Marks, Ray Dalio, Warren Buffett, and the core macro principle most professional traders quietly operate by. Liquidity is the tide, and price is the boat. Then we'll answer the question everyone asks: is it really as simple as buying in a bear market and selling in a bull market? And if it is, why do most people still fail? So let's start with a simple definition that matters more than people realize. A bull market is not just price going up. A bull market is a period where the market's default behavior is to reward risk. Dips get bought, bad news gets shrugged off, and even mediocre assets rally because the environment is supportive. A bear market is not just price going down. A bear market is a period where the market's default behavior is to punish risk. Rallies get sold, good news fails, and even strong assets struggle because liquidity and confidence are missing. The defining difference is not the candle color. It's the behavioral physics of the market. Now, why do bull markets happen? You can reduce it down to one big force and three supporting forces. The big force is liquidity. The supporting forces are psychology, narrative, and positioning/leverage. Bull markets happen when money is available, confidence grows, and the market's positioning is set up to reward buyers. Bear markets happen when money becomes expensive, confidence collapses, and positioning gets forced to unwind. In traditional markets, the biggest driver of liquidity is central bank policy, interest rates, quantitative easing, and credit conditions. When rates are low and money is cheap, borrowing expands, corporate profits get valued more highly, and investors reach for returns. When rates rise and money tightens, everything reverses. Crypto is even more sensitive to this because it has no cash flow. Bitcoin doesn't pay dividends. Most tokens don't throw off predictable income. So they behave like high-duration assets. They're basically pure liquidity instruments. When money is easy, they fly. When money is tight, they deflate violently. But crypto has its own internal cycle amplifier, the reflexive speculative engine. Reflexive means price influences belief. Belief influences demand. Demand influences price again. When price rises, people feel safer. When people feel safer, they buy more. That pushes price higher, which makes more people feel safe. And that's how bull markets accelerate into mania. In bear markets, the same reflexivity runs backwards. Price falls, people feel unsafe, they sell, price falls more, fear rises, selling increases. This is why crypto cycles look exaggerated compared to equities. The market isn't just moving on fundamentals, it's moving on belief loops. Now, layer on the crypto-specific piece: supply schedules and the Bitcoin halving narrative. This matters, but not the way most people say it does. The halving reduces new Bitcoin issuance, which is a real supply effect. But the bigger effect is psychological and positioning. Markets front-run the halving. People anchor their expectations to it. Funds market around it. It becomes a coordinated narrative. It's not magic. It's a synchronizing story that helps align capital flows. Every cycle, you see the same rhythm. A long accumulation phase after the crash, a disbelief rally, a real bull phase where institutions and bigger money step in, then a mania phase where retail arrives late. Then it breaks. Then it falls harder than anyone thinks is possible. Then it bottoms while everyone is sick of it. Then it repeats. Let's put real history behind this, because patterns are only useful if you've lived through them, or at least studied them. In 2013, Bitcoin ran hard, and then collapsed about 80% plus after the market realized it wasn't ready yet. Exchanges weren't secure, and regulation fear was real. In 2017, Bitcoin and the entire market hit a speculative peak. Everyone remembers the feeling. Every coin going up, ICOs printing money overnight, people buying anything with a logo, and this time is different, being the dominant belief. Then 2018 happened. Why? Because the narrative ran ahead of reality. The easy money dried up, regulation risk increased, and the market was overloaded with speculative supply. It wasn't just that price got too high, it's that the system ran out of marginal buyers. Once the marginal buyer disappears, the market falls until value buyers appear again. Then, 2020 to 2021 happened, and it felt different. It wasn't just retail. It was institutions. It was stimulus. It was the Fed cutting rates to near zero. It was money everywhere. It was companies putting Bitcoin on balance sheets. It was NFTs, DeFi, and a real wave of product innovation. But even that ended in the same place. 2022. Why? Because the Fed tightened. Liquidity reversed. Leverage had built up massively inside crypto. Lenders, yield products, over-collateralized systems, under-collateralized risk, and a whole structure that assumed price only went up. When price stopped going up, the structure broke. Terra collapsed. Firms blew up. Confidence vanished. And once confidence vanishes, even good assets get sold because the market is trying to survive, not optimize. That tells you something important. Crypto cycles are not just Bitcoin did a thing. They're the combined result of a macro liquidity cycle and a crypto leverage/narrative cycle. When both are aligned, you get explosive bulls. When both reverse, you get brutal bears. Now, what causes the switch? This is where most people get it wrong. They think the switch is one headline, a ban, a lawsuit, a crash, a CPI print. Sometimes that's the trigger, but not the cause. The cause is usually that the market has become unbalanced. In a bull, the imbalance is usually too much optimism, too much leverage, too much expectation of easy gains. In a bear, the imbalance is too much pessimism, too much forced selling, too little belief. The switch occurs when the imbalance reaches a point where price movement forces behavior to flip. There are usually 4 stages of the switch from bear to bull. First is capitulation, the final puke, when people stop caring about price and just want out. Second is depression and apathy. Nobody wants to hear about crypto. It's boring. Volume dries up. It feels dead. Third is smart accumulation. Long-term holders, patient money, and builders keep showing up quietly. Fourth is a catalyst. Could be macro easing, could be a narrative shift, could be the halving approach, could be a new product wave. Price starts rising, but most people don't believe it. That's the disbelief phase. The early bull market feels uncomfortable because everyone is traumatized. That's why early bulls are the best opportunity. There's still skepticism, which means there are still buyers who haven't bought yet. Then the bull matures. The story becomes more credible. People stop laughing. Institutions begin to participate. Retail starts to notice. Liquidity improves. Then you get the second switch. Bull to bear. Again, it's stages. First is excess. Leverage grows. Speculation spreads to low-quality assets. Price goes parabolic. Second is distribution. Smart money starts selling into strength quietly, not loudly. Third is a trigger. Could be macro tightening, could be a major failure, could be regulation fear. Fourth is unwind. Leverage collapses, forced selling hits, and the market finds out who actually had conviction and who only had momentum. Now let's bring in some expert thinking here because it matters. Howard Marks, one of the most respected credit and cycle investors, talks constantly about cycles being driven by psychology, risk aversion, and risk tolerance. In a bull, risk tolerance expands. People accept lower returns for higher risk. They stop demanding margin of safety. In a bear, risk aversion explodes. People demand massive discounts and still don't want to buy. Marx's core idea, is that cycles happen because humans don't stay rational. They swing, and those swings create mispricing. Ray Dalio talks about the long-term debt cycle and how credit expansion and contraction drive booms and busts. Warren Buffett's famous line, "Be fearful when others are greedy and greedy when others are fearful," sounds like a meme, but it's basically a cycle survival rule. Now let's translate that into crypto reality. In a bull market, people stop doing diligence. They buy because it's going up. They don't ask, what happens if this goes down 30%? They assume it won't. They start using leverage. They start borrowing against assets. That creates fragility. The market becomes a tower of assumptions. In a bear market, people stop thinking long-term. They assume it will never recover. They sell at the bottom because they want emotional relief. That creates opportunity because the market overshoots to the downside, just like it overshoots to the upside. So, is it as easy as buy in bear, sell in bull? In theory, yes. In practice, no. Because it's emotionally backwards. Buying in a bear feels stupid. Selling in a bull feels stupid. In a bear, the news is bad. Your timeline is negative, and price is falling. Buying feels like catching a falling knife. In a bull, the news is good. Your timeline is euphoric, and price is rising. Selling feels like missing out. Most people can't do the emotionally correct action because the crowd energy pushes them into the wrong one. There's also a more technical reason why it's not easy. You don't know you're in a bear market bottom until after it's passed, and you don't know you're at a bull market top until after it breaks. That's why the best approach isn't to try to buy the exact bottom and sell the exact top. The best approach is to operate with a process that works across cycles. If you want a simple, realistic process, it looks like this. In bear markets, you accumulate gradually, not all at once. You dollar cost average. You focus on quality. You assume volatility will continue. You preserve cash so you can keep buying if it drops. You don't need the bottom. You need good average prices. In bull markets, you de-risk gradually, not all at once. You take profit into strength. You reduce leverage. You rebalance. You prepare for drawdowns without panicking. Again, you don't need the top. You need to not round-trip your gains back into a bear. Now, if you want to explain why patterns repeat, here's the best simple framework. Patterns repeat because incentives repeat. Humans repeat behavior. When people see price rising, they chase. When they see price falling, they flee. Institutions repeat cycles too, just on different time frames and with more tools. Media repeats cycles because it amplifies what's already happening. Social media repeats cycles because it rewards emotion. All of that creates the same psychological arc. Disbelief, optimism, euphoria, denial, fear, capitulation, apathy, then repeat. The assets and narratives change, but the human loop stays the same. We also need to talk about the key switch mechanisms that professionals watch. For bull to bear, professionals watch for rising leverage, euphoric sentiment, parabolic price action, and macro tightening. For bear to bull, they watch for capitulation, stabilization, improving liquidity, and the return of demand. In crypto specifically, they watch things like exchange balances, long-term holder behavior, realized profit/loss, and whether Bitcoin can reclaim long-term moving averages. In traditional markets, they watch credit spreads, yield curve signals, and central bank pivot language. Now let's anchor this in the current market so it feels relevant rather than historical. Right now, when you see a pullback after a strong move, the question is this the start of a bear or just a bull market pause? And the answer comes back to behavior. In bull markets, pullbacks tend to be bought. In bear markets, rallies tend to be sold. That's the simplest diagnostic. If the market dips and then stabilizes, with buyers showing up, it's likely a pause. If the market rallies and then gets aggressively rejected, with sellers dominating, it's likely still bearish. You can't know instantly, but you can observe the pattern of reactions. Another way to explain the switch is to talk about narrative exhaustion. Bull markets often die when the narrative stops attracting new money. You'll notice it because good news stops moving price. Big announcements get shrugged off. Everyone who wanted in is already in. That's a top condition. Bear markets often end when bad news stops moving price. Terrible headlines hit and the market doesn't make new lows. That's a bottom condition. It's not magical. It's simply the market telling you that selling pressure is exhausted. Now, I want to be very direct about the easy strategy question. It is not as simple as buying in the bear and selling in the bull, because you have to define what bear and bull are in real time, not hindsight. The better realistic strategy is accumulate when the market is undervalued and hated. Reduce risk when the market is overvalued and loved. That's still the same concept, but it's more practical. It doesn't require you to call the exact turning points. It requires you to recognize regimes. And this is where most people lose. They don't operate with a regime mindset. They operate with a day-to-day emotional mindset. They get pulled around by the chart. They buy because they feel late. They sell because they feel scared. They confuse short-term noise for regime change. The market punishes that. So to close this deep dive, here's the message I want you to leave with. Bull markets and bear markets aren't random. They're not gods flipping a switch. They're cycles created by liquidity, psychology, narrative, and leverage. The switch between them is usually a shift in liquidity and a shift in confidence, expressed through positioning. The patterns repeat because humans repeat. And no, it's not easy to buy bear and sell bull, but it is possible to build a process that takes advantage of those cycles without needing perfect timing. If you're listening and you've ever thought, why does this always happen to me? The answer is usually that you're arriving when emotion is highest. The fix is to be early, patient, and systematic. Buy when it feels boring and uncomfortable. Trim when it feels easy and obvious. And above all, stop treating markets like they owe you a straight line. Drop your thoughts in the comments, and as always, we will see you at the top.